Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is investing in dividend stocks. Oil prices are up, stock prices are down. The stock market has been bouncing from highs to lows over the last couple of months now, so it's kind of uncertain times. So today I wanted to talk about building a dividend portfolio for uncertain times. Should be a pretty interesting discussion. We have a lot to cover. We're going to be reviewing our current positions, looking at what's going on with the markets, and entering a new position into that investing example portfolio. So before we get to any of that, though, let me first of all say hello to everybody who's already chatting in. Great to see all the familiar names. I already see somebody acknowledging that it's their first time here, so great to see you as well. But hello there, Donald and Rojo, Aviva. We have Life in the Fast Lane, Richard, Cecil, Eva, and everybody else. Thanks for joining us week after week. We always really do appreciate your attendance and your contributions to these discussions. If you are among those that are here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy the recording. It's a great way to watch these webcasts. But you're certainly invited to join us here on Thursdays. This webcast series kicks off promptly at noon each Thursday, so we'd love to have you here in our live stream audience. I also want to let our live stream audience members know that my very good friend Brent Morris is hanging out in the chats with us. Brent and I just entered our 22nd year together on this coaching team. So yeah, we go back a long way. Brent was there on day one when I joined the team. So thanks for having my back, Brent. Brent's just going to answer any questions that I can't get to out there in the YouTube chat. But Brent and I would also like to issue an invitation to everybody watching, whether you're live or you're watching on the archive, to follow us on social media. You should be following your favorite Schwab presenters there. You can follow us on X or on LinkedIn. So you can find and follow Brent on X at Brent Moore CS. You can find and follow me on X at Cameron May CS, or you can hop over to linkedin.com/in and then /Cameron May CS. Give me a follow there. But let's get into this discussion of building a dividend portfolio for uncertain times, right? And of course, as we do, there are risks associated with trading and investing. So bear these important disclosures in mind. This material is intended for general informational and educational purposes only. There are risks associated with investing in dividend-paying stocks, including but not limited to the risk that stocks may reduce or stop paying dividends. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right, so let's set the agenda for today's discussion. The very first thing that I want to do is let's go have a look at what's going on with the markets. I would typically kind of start off with a portfolio review. Let's sort of mix things up. I don't know, we fairly frequently just go right to the markets, but kind of some movement in the markets today, and I wanted to give that some context. So we're going to be looking at the S&P 500. We're going to be looking at what's going on with fixed income securities or bonds. And then we're going to look at what's happening with dividend stocks in reaction to some of those other variables. And then we're going to talk about how an investor might build a dividend portfolio as they attempt to prepare for these sorts of times of uncertainty. And to support that effort, we're going to learn some tools that are available on the Thinkorswim desktop platform. We're going to be conducting a scan for a new position for our example portfolio and then adding that to the portfolio. Obviously discussing along the way how it might assist, we can never know for sure, but how that might assist with navigating uncertain times. All right, so let's go right to the Thinkorswim desktop. This is the simulated trading environment known as paper money. Here are our current positions. We'll be circling back to those, but I want to go have a look at what's going on with the markets. So starting with the S&P 500, we don't always look at the S&P because we tend to look more at the dividend stocks rather than just a broader index of stocks. But yeah, S&P is down about 1.26% today. You can see kind of a strong gap to the downside there. And that seems to have been driven by an escalation of tensions in the Middle East. We've seen an attack on a couple of Saudi vessels, not in the Strait of Hormuz, but in the Red Sea. And so that's kind of an expansion of those shipping channel concerns. And so oil prices have kind of spiked up today. And they're hitting 12-month highs. Now, in reaction to that, I think it's likely that a lot of investors are trying to look down the road, and prices, the oil prices, might influence prices in general. Yep, we're starting to encroach on that concept of inflation again. So concerns of inflation are potentially bubbling higher. So if inflation is a concern, I know I'm connecting quite a few dots here, but we're trying to get back to why the market's behaving the way they are. But if inflation concerns are rising, how might the Fed react to those concerns if it shares those concerns? Well, it might make it less likely for a future rate cut. So that tends to spur more inflation. And the Fed might not want to be throwing fuel on the fire, so to speak. So no rate cuts have led to what happening with yields on bonds, or no rate cuts, no expectation or reduced expectation for future rate cuts. Yeah, let's go have a look at what's going on with bond yields. So here's TNX:CGI is the index of 10-year bond yields that we refer to in this webcast series. And you can see, yep, we've spiked up to 12-month highs. And actually, historically, if I go to a longer term chart here, let's switch this to maybe, should we go to a 10-year? We don't typically see yields this high. We could even extend that out over a 20-year time frame. Let's go to a 20-year monthly. And you can see, really, it's been a long time, going all the way back to almost 20 years ago, before we've seen yields that were at all consistently higher than they are right now. So why do we care about yields? If you haven't been in this webcast series before, isn't this about dividend stocks? Well, for dividend stock investors, they may see bond yields as kind of an indication of the strength of the competition. So if we're invested in dividend stocks, but everybody else is going over to try to get higher yields from bonds, then it might cause some downward pressure on dividend stocks, and it might cause our portfolio to kind of lag. So we do tend to keep an eye on what's happening with yields. That provides just some additional context here. Yeah, Eva says there may be a run to the T-bills. She says for safety is always, just about anything an investor can do. If it can carry the potential for an increase in value for that investor, there's some risk associated with that effort, right? But that's what's happening with yields. The quote unquote competition appears to be strengthening. So what's going on with dividend stocks more specifically? Not just the S&P 500 or a broader distribution of stocks that may be paying dividends or maybe not. Let's look at a different index. We look at SPHY DMUT each week. So this is an index of dividend stocks. These are stocks that have been increasing their dividends every year for the last 50 years and that are also component companies of the S&P 1500. So these are known as the dividend monarchs. And this chart is an index of the performance of that group of stocks, including all dividends paid. So it's known as a total return index. That's what the TR stands for. So including dividends, here's what's been going on with the dividend monarchs over the last 12 months. And actually, they've been doing fairly well, even with yields on bonds climbing relatively sharply up to those 12-month highs. We've really barely faded away from the 12-month highs on the dividend monarchs. So it still seems to be dividend stocks are actually holding up comparatively well in this market environment. And so we're seeing that within our portfolio. Let's go over to our portfolio. And what we're going to do, let's frame our portfolio within the context of current market uncertainty. Now, I'm going to say, even though I'm going to be titling this webcast something like Building a Dividend Portfolio for Uncertain Times, are times ever truly entirely certain? I don't think so. Otherwise, we'd all know exactly what to do and how to reallocate our portfolio. So times are uncertain basically at all times. And so for some investors, they maybe just prefer to prepare as best they can for whatever uncertainty lies ahead, recognizing that uncertainty is essentially inevitable. So what are some steps that they might take to prepare for that uncertainty? Well, there are models that attempt to address this, right? But recognizing that times are basically always uncertain, some investment models suggest that maybe we diversify our portfolio. Now, we already know diversification is not a guarantee that we're not going to lose money if the markets go down, but the concept might be maybe we can slow the bleeding if we happen to spread our portfolio across a range of, let's say, sectors. If one sector is particularly exposed to whatever that uncertainty is, maybe another sector might be less sensitive to those causes of uncertainty. It might hold up a little bit better, potentially even thrive under the same economic uncertainties that are causing other sectors to fall. So what we're doing in this example, what we have been doing right since we kicked off this webcast series, January 1st of this year, is establishing a diversified portfolio across a range of the 11 different sectors that make up the S&P 500. And right now, we already have positions in 9 of the 11. There are a couple where we don't currently have positions. But you can see we have some healthcare, we have some consumer staples, consumer discretionary, we have materials, industrials, and so on. And I don't think that's a huge surprise to anyone that diversification is a typical approach within traditional models of that are attempting to be defensive. So, but we're observing that in this webcast series. Now, another thing that we've done that not everybody does, but we have emphasized what's known as beta. This is a gauge of volatility. And you can see for each of our companies, there is a beta value. Now, beta can be, well, I should start off with, let's say that an average company with average volatility, beta is a gauge of volatility, would have a beta score of 1. What we do is we benchmark a company historically, how has it moved in relation to the S&P 500? And if it just tends to move right along with the S&P 500 up and down, we would say that it has a beta score of 1, or it has about a 1-to-1 relationship with the movements of the S&P 500. If it tends to be less volatile than the S&P, but generally moving in the same direction, it would have a positive beta score, but below 1. If it's more, if it has a positive relationship with the S&P, it tends to move in the same direction, but it's a little bit more volatile, it would have a beta score above 1. And what you notice here is that all of our beta scores are below 1, and our average beta is 0.67 across all of our positions. So what might we say about our portfolio? Let's say if the market is down 1% today, which happens to be the market being defined in this case as the S&P 500, we might anticipate that our portfolio might be down about 0.67% on such a day. It's not guaranteed. This is just looking at how these stocks have tended to behave against the S&P 500 over the last 5 years. And but using that to gauge anticipated future levels of volatility. So now that sounds good. Oh, good. So Cameron, you're telling me if the S&P is down 1% today, we would expect our portfolio to maybe be down around 0.67%, or only about 2/3 of that downside volatility. Yep, that's the expectation for this portfolio. But if we flip that on its head, this is the trade-off for an effort to lower volatility. Volatility can work in both directions. So if the S&P were to pop 1% today, how much might we expect our portfolio to rise? Well, only about 2/3 that much, about 67 cents on the dollar, as an estimate. I can't emphasize that enough. These are very generalized, but across a broad spectrum of stocks, probably pretty serviceable. All right, so diversification across a range of sectors might be one way that as a dividend investor is building their portfolio, that might assist with those uncertain times. Certainly not a guarantee. Using a benchmark of volatility, such as beta, and then looking for stocks with potentially lower volatility historically, might prepare us for lower volatility in the future. Could change, but we'll see. Now, there's also something else that may help let's leave our portfolio for just a moment. Let's go back to our chart of the S&P 500. And that is, it's right in the title of this webcast series. It's called Investing in Dividend Stocks, not trading dividend stocks. There's a big difference between investing and trading. Investors tend to have a long-term horizon for their individual positions and for their portfolio writ large. A trader, they're still trying to grow their portfolio over time, but they're attempting to accomplish that with shorter term positions, maybe in and out over the course of a few days to a few weeks, maybe even shorter time frames sometimes. But that longer term horizon has actually been a pretty good way historically. Again, we can never know what the future holds, but a pretty good way to help an investor get through uncertain times. I want to go back. Let's do a little history lesson here. I want to look back over basically my investing career. Right? I'm a 54-year-old man. I've been investing for a long time, but due to just my age, we've basically been over the last 30 years. I've actually been in this industry. I'm almost there. Wow, that's crazy. Yeah, first took a professional role in the industry in 1997. So let's just say this is sort of a review of my professional career. But let's come up here to our time frame, and I'm going to switch this to a monthly chart going back to, if you can see this, July 23rd. Today's July 23rd of 2026. Let's go back to July 23rd of 1996 and do a little kind of an uncomfortable history lesson of the S&P 500. How many of you can remember these events? Ooh, the tech bubble started in 2000. This was the dot-com bubble. I was a margin analyst back then. And boy, that was some busy times when everybody's portfolios were in trouble. Not everybody, but a lot of people. In any case, those were some rough times. But a recovery started within a couple of years. And a longer term, maybe a dividend investor, maybe just an investor with a long-term horizon, got back up to a break-even point right in time for the real estate crisis. But still, making progress and potentially collecting dividends along the way that may contribute to a net positive return over this time, even this rougher period. We hit the real estate crisis, also known as the financial crisis. Markets had a strong sell-off for about 18 months. And then the recovery began again. So it's not necessarily adjustments that are being made in a portfolio, but the tendency of the markets themselves over time to recover and advance. And then we've had other setbacks as well in the 30 years. Global pandemic, the inflation surge, tariff tensions, the current tensions in the Middle East. But overall, where do we find ourselves 30 years later? Yep, without having made significant changes to a portfolio, very likely doing quite well over that period, despite those strong times of uncertainty that we really, if we knew they were about to happen, maybe we could sidestep them. But that's the point of uncertainty. We didn't know. So taking that long-term perspective may assist with riding these events out. And it can help quell some pretty strong emotions when those inevitable tough times come. All right, but let's go back here. Let's switch this back to a one-year chart. So diversification, a lower position in portfolio beta, taking that long-term outlook. But a final step that a dividend portfolio, that a dividend investor might do in their efforts to prepare for uncertain times in their portfolio is just sort of in the nature of dividend paying stocks themselves. We're going to talk about history again, and history is no guarantee of the future, but historically, dividend stocks have tended to have lower volatility to essentially be less uncertain in uncertain times. Now, I'm going to definitely qualify that statement, but why might dividend stocks, let's start to break that statement down. Why might dividend stocks experience historically lower levels of volatility during uncertain times? Well, it may not, it's probably not, or it may not be directly related to the fact that a dividend is being paid. Maybe that helps, but it might more have to do with the nature of the companies that pay dividends. On average, in general, they tend to be larger, more mature companies. Maybe they have more stable cash flows. Maybe they have more stable revenues. Um, they're potentially just better prepared themselves for uncertain times, to weather the storm, so to speak. Now, it also might have to do, yeah, Janelle, they've been around for a while. Might also have to do with the kinds of people who invest in those companies. Who buys dividend stocks? Is it the traders looking for excitement over the next 2 weeks or 2 months? Or is it someone with the long-term horizon looking for income from that security, willing to surrender conceptually upside potential in exchange for mitigated downside exposure? Yeah, it tends to be, or at least this, it's all of these are, we can't ever say from one company to the next exactly why it's more or less volatile than another one. But yeah, dividend paying companies are very likely to attract investors with longer term horizons who are less likely to be reactive to uncertain times and therefore maybe less likely to pile on and create greater volatility during those uncertain times. So possibly just the mere fact that we're buying dividend stocks may reduce that portfolio volatility. And I said I was going to qualify that statement. I think I've already done that, right? I can say that's historical tendency. It's not a guarantee in the future. But also this doesn't really seem to bear out with high dividend paying companies. If a company is really trying to stretch and pay extremely high dividends, let's just say higher dividends, that many multiples of an average dividend, then that sort of assumption tends to break down because there may be other motivations for that company to pay that high dividend. There may be other reasons. If a company is paying a very high dividend, it might not have intended to do that, but it's just actually a function of the fact that its price has collapsed and artificially propped up its yield. Price collapsing may be coming from just possibly maybe not a strong corporate model. But in any case, yeah, a few steps that an investor might conceptually take in their efforts to build a dividend portfolio for uncertain times. So let's go add to our portfolio with all of that as a backdrop. And I want to do a quick review of our current portfolio. So right now, we're 85% invested in our $200,000 example portfolio. So we have 17 different positions, each comprising initially about 5% of our $200,000 portfolio. And we've allocated those across a range of 9 different sectors. So right now we have 8 sectors where we already have 2 positions. We have 1 sector where we have 1 position. We have 2 sectors where we have no position yet. So those are technology and communications. Our average yield across all those stocks is about, I think I checked this morning, at about 3.34%. That's about 3 times the average for an S&P 500 company that's paying dividends right now. Average is about 1.1%. We're at about 3.3%. Our beta, yeah, about 0.67. So we would anticipate about 2/3 of average volatility as markets move. Oh, and there is a survey. Okay, I'll quickly make a note of that. As a matter of fact, let's just hit the pause here for just a moment. Because there is a survey here in the chat window. I noticed that. So for those that are here in the live stream audience, do me a favor. Look in your chat window right now. Click on that survey link that's been provided. And then fill that survey out when the webcast is over. You can give me some honest feedback. All right, but just so you know, it's a really short survey, 2 questions. You just click a couple of dots and you're done. And you can also leave comments or suggestions. So 2 questions, a comments box and a suggestions box. But even though it's a short survey, it's still important to me, and I will take the time to read through the data that you provide through your answers. I read through your comments, I read through your suggestions, and it definitely helps. So thanks for doing that for me. But going back to our portfolio here, how's the portfolio doing year to date? Now, we just started building this in January. We've been adding basically one position per week, except when I took vacation and some personal time off. So in general, so we're toward the end of July here, our average position is about, we've held it for about 4 months. And overall, we're up about 9.3%. That's actually outpacing a fully invested portfolio in the S&P 500. That could turn though. We'll see how the next 5 months or 4 months go, the remainder of 2026 versus 5 months. Anyway, the remaining 5 months. Anyway, versus these first 7 months. But up 9.3%. Plus, that doesn't reflect the maybe 1.5%, I would say probably more like 1.25% aggregate yield that we've collected across all of our positions so far. So overall, we're probably up about 10.5% on that portfolio in unrealized gain plus dividends collected. But what we need to do now, let's continue to build this portfolio out. And we are going to be keeping an eye on diversification. We're going to be emphasizing volatility exposure, at least as measured by beta. And we're going to be continue to look for dividends. Now that's not an exhaustive list of our priorities. So what I like to do here, let's actually let me delete this one here. I don't need that gadget down there. But we do have priorities when we're adding to our portfolio. These are just example priorities for it as a dividend investor. It's not intended to be exhaustive as a list. It's not intended to be the list. But yeah, yield is going to be number one. Number two is diversification. Number three, consistency of dividend payments over a long period of time. Number four, bear with me for just a moment. Just need to adjust something here off to the side. Debt, because corporate debt can be a potential risk to a company's ongoing ability to keep making their dividend payments. Number five, the volatility of the stock. Number six, the net performance of price plus the dividends being paid. So those are our six stated sort of objectives for this portfolio. So let's go run a search for a stock that we don't already own, maybe that's in a sector where we don't already have a little bit of a concentration there. So how do we do that? Well, let's go to a scan. And I'm going to reset this just so we start with a clean slate. And we're going to be using our, let's load up our scan now, our personal scan called the Dividend Working Class. If you're not familiar with this is just a dividend scan that we previously built in a previous discussion. If we want to see that discussion, you can go to our channel. By the way, if you're new to this webcast series, make sure you subscribe to our channel on YouTube. It's called Trader Talk Schwab Coaching Webcasts. And you can just go down below the video stream right now and click on the subscribe button. It only takes a second to subscribe. It doesn't cost anything to subscribe. But this is where our channel is where you can join live streams like the one we're having right now. You can find playlists of previous webcasts, or you can even do searches. Let me type in working for a working class. And this is going to scan through the archives of our previous webcasts, and it finds the discussion that we had called These Are the Dividend Working Class. And we built this scan in that webcast. You may want to check out that video. That'll explain what the dividend working class are. But in brief, here's what this scan is looking for. It's scanning in the S&P 500 for companies that are yielding, because yield is a point of emphasis, between 2 and 6%, not those high yields where historically there's been a tendency toward potentially an increase in volatility. This scan is looking for $10 billion companies, larger cap companies, not truly large cap actually. Beta between 0.5 and 1.5, so below average volatility to above average, about 50% above average. Debt loads of 50% comparing long-term debt to total capitalization. That is, if we were to make a big pile of, where a company derives its capitalization, including debt, common stock, and preferred stock, what percentage of that is from debt? And we're just keeping this under 50%. So this is largely accomplishing what we've outlined as priorities here. Yield. Consistency might be assisted by larger companies that are able to potentially pay their dividends more consistently. Lower debt can assist potentially with consistency. Lower volatility, but diversification and performance we still need to check. So here's a step that we can take for diversification. Within this portfolio, we already have positions across 8 of our sectors, but there's a sector where we only have one stock. It's consumer discretionary. How about let's scan for stocks that meet all these criteria that are S&P 500 companies, but just in that consumer discretionary sector. So let's do that. Let's go right here. We're going to run this scan through the S&P, but we're going to intersect with means it has to be S&P plus this. We're going to intersect with a specific industry. And in this case, it's going to be consumer discretionary. Let's just look in all consumer discretionary. But then we're going to exclude a specific group of stocks. And that is, I have a personal watch list of our current dividend stock positions. Those 17 stocks we already own, no sense in running a scan that finds the same 17 stocks. So let's eliminate those from the scan. So we're looking for S&P companies in the consumer discretionary sector. We don't want to see the ones that we already own, but anything that's displayed needs to meet all of our other search criteria. And let's run a scan here. And it looks like there are just 4 companies in that sector that otherwise meet all of our criteria that we don't already own. We have Nike, we have Best Buy, we have Lennar, we have Genuine Parts. I'm going to tell you, I'm going to eliminate Lennar right off the top. Why would I eliminate Lennar? Because this is kind of in the weeds a little bit, but for some investors, there's a little bit of an argument between, does this really legitimately belong in consumer discretionary? There are others that make a case it's really more of a real estate company. We already have a couple of real estate stocks. If we wanted to check that, we could actually just go up here to our Analyze tab, go to the fundamentals, and if I type in LEN for Lennar, and we go down, we read its description. Here's their corporate, what's known as a company profile, but it's basically a description of the company. What does this sound like? Lennar Corporation, together with its subsidiaries, operates as a home builder, primarily under the Lennar brand in the United States. Includes construction, sale of single-family detached homes, purchase, development, and sale of residential land. I'm not the one who put these things into different categories, but yeah. Anyway. All right, Eva, I'm not gonna reply to that one. Anyway, but let's go back and look at our other ones though. We have Nike, we have Best Buy, and we have Genuine Parts. So that's an auto parts supplier. And what we're going to do is let's look to see if we can qualify. So diversification, yeah, this is in the consumer discretionary. We only own one of these stocks. What about performance? Performance meaning, what is the stock price doing in addition to paying dividends over a long period of time? Not since last Wednesday or a month ago. But let's go to the charts. And I want to load up a long-term chart. Let's maybe bring up a 10-year weekly chart. And let's look at Nike first. And I want to adjust this to show total returns. Yeah, Nike's stock price has just been dropping. It has been paying dividends along the way. So That might prop it up a little bit, but if I combine those two on a single chart, let's click on the little gear icon. So if you didn't see what I was doing, I'm click on this little gear, and I'm going to go to Equities tab because this is a stock or an equity, and I want to adjust the chart to show price plus dividends. So if I change this to adjust for dividends all, it's going to adjust the chart a little bit, or maybe a lot, to include all the dividends that have been paid over the last 10 years. So if I click apply and click OK, net, yeah, Nike still heading down, not a surprise. What were our other ones here? We had Best Buy. Best Buy net, actually, this doesn't look like a lot. It's kind of been chopping sideways for a number of years. Very recently, kind of catching a tailwind and heading quite a bit higher, 55 up to 87 in a relatively short period of time. This is going to be, that's price driven, maybe one dividend collected in that time frame. But overall, this looks like it's gone about 9 or 10x over the last 10 years for an investor. Most of that happening here or right through here. And then what was our final one? So should we say maybe Best Buy is in the running as a candidate? Let's compare that to Genuine Parts. And what I would like you to do is give me your vote, because we're going to be adding one of these to our portfolio. So Genuine Parts, oh, actually, I might still make a case for Nike. I think that there are some investors, remember, not traders, but investors, who might see Nike through a very different lens over the long term. Genuine Parts been kind of struggling over these last few years. It's come up quite a bit recently, much like Best Buy, kind of sagging back a little bit. But overall, left to right, from 10 years ago to today, about a doubling of value, maybe not quite tripling. Let's go back and have one more peek at that Nike long-term look, though. Do your best over the long-term perspective as a dividend investor. What case might be made? Well, someone might say, well, at the very least, Nike is it's only about 25% the cost that it was 5 years ago. Now, as price goes down, if the dividend isn't cut, and Nike hasn't cut dividends, the yield goes up. And so if Nike can pull out of this, if they can start to go up, we may get over time an increase on what we call our yield on cost. If we can buy at a low cost and price goes up and Nike continues to build on or continues to increase its dividends, yeah, Eva says it might be a value stock, right? We're not necessarily looking through that value lens in this webcast series consistently. But let me just open the voting up right now. I'm going to say, how about we make it shall we buy Best Buy due to its longer term strength, or potentially Nike as a possible oversold candidate? What do you think? So I'm gonna watch for the first symbol to get 3 new votes is going to be the one that we add to our example portfolio. I can already see there are 2 votes. Here we have Life in the Fast Lane, Nike. Bogus Chinchilla says Nike. Eric says Best Buy. Steven says Nike. Okay, Nike it is. BJ says Nike. Let's do it. We'll see if this multi-year selling continues, or maybe we're down at those lows, and we'll see if Nike can kind of pull out of this. But in the portfolio it goes. We have $10,000 to invest, just like we do in each of these. Let's bring up Nike. Is that not linked? Yeah, it is linked. Oh no, it's not linked to the chart. I want to link my charts. There we go. Anyway, back to our trade tab. Nike's basically a $41 stock, but let's get out our calculator. 10,000 bucks that we invest each time. Let's divide that by, let's say, $40.90. We don't know exactly how much we're going to spend. That's about 244 shares. So let's go ahead with a purchase, going to buy. We click on the ask price to create a buy order. Going to buy 244 shares. Of Nike. How about we put a limit on this? Let's say that we're willing to spend up to, a few pennies more. Let's say $41. That'll be our limit. I know that there are a number in our audience who they don't like it, makes them nervous when I put in a market order, because market orders, they should create a little bit of nerves. It means that we're willing to just spend whatever it takes. Hey, market, whatever you want me to pay, I'll pay it to get these 244 shares. Might be the same price as we're seeing right now, might be lower, it might be higher. If we put on a limit order, we're putting a cap on how much we're willing to spend on a per share basis. But if the price happens to move above that cap before we can get filled, it may not fill. We might not buy these shares at all. So there are pros and cons to each market or to each order type. But let's put in our buy order, 244 shares of Nike, limit at $41. That would bring our total investment just right about $10,000 if we pay $41. There's no commission on this trade. There can be on some types of trades, but I'm going to send this order off. And let's see if we can get that filled. I suspect, shares are trading at 40.87. We just said that we're willing to spend more than that. Yep, and we just filled $40.88. So there we go. We own 244 shares of Nike. We have a stock. If we go back to our scan, we can see Nike's yield about 3.5%. That'll bump up our average yield a little bit, assuming it remains consistent. Bump up our average yield on our portfolio. That position has been dropped. Let me just double check. Yep, there it is. 244 shares right there. And we'll see how this goes from here. But guys, we've accomplished what I set out to do today. I wanted to talk about building a dividend portfolio for uncertain times. And this current market conditions provide kind of an interesting backdrop to set the stage for that kind of a discussion. I hope this was an interesting discussion for you. Always hope it's valuable, but this is what we do on Thursdays. And I hope that you'll put it in your personal calendar to join me on Thursdays, or at least to watch for the webcast archives for these Thursday investing and dividend stock discussions. But I have other webcasts all throughout the week, as does the rest of the team. So make sure that you're taking full advantage of the educational offerings from Schwab. Starting with, if you haven't done it yet, make sure that you're subscribed to our Trader Talks channel on YouTube. Go down below the video. Click on the subscribe button. It doesn't cost anything to do that. It only takes a second to subscribe. But our Trader Talk Schwab Coaching webcast is where you can join our live streams. You can do keyword searches through our archives, or you can just go right to the playlist. Let's go to the playlist and look for investing in dividend stocks. This one happens to be right up there toward the top. We can just click on view full playlist, and we can see last week's discussion where we went to schwab.com and we built a screen for dividend stocks. Will, glad you liked it. Lakshmi says, do I add set stops? I do not. Nope. We do instead some rebalancing if it meets our rebalancing requirements. We've discussed those in previous webcasts. We'll discuss them again in future webcasts, but no stops on these positions. Anyway, also make sure that you're following us on social media. You can find and follow your favorite Schwab presenters on social media. You can find us on X. You can find us on LinkedIn. You can follow Brent on X at Brent Morris CS is his handle there. You can follow me on X at Cameron May CS is my handle. There's the guy. There's the that's Scone Castle in Scotland in the background. But if you reply to one of my posts on X, I just try to reply right back to you. And that opens the channels of communication when the camera's not on. You can also do the same thing on LinkedIn. Just go to linkedin.com/in and then go to /Cameron May CS. So Cameron May CS, that's my handle on both platforms. And if you reply here, I just try to reply right back to you. So kind of choose or both platforms. Now, I also want to thank everybody for all the thumbs up. That's really appreciated. We got 115 people watching the live stream right now. We already have how many? We have 57. I've already clicked thumbs. That's half. Nice. That's excellent. Every time you click the thumbs up, it helps me. It gives my video a boost in the YouTube algorithm. It's also a nice pat on the back to your presenter. Definitely appreciated. Now, my final request from you is there is a survey for this webcast. So if you're in our live audience, click that survey link now. You can give me your feedback. It's just 2 questions and then a comments box and a suggestion box. But I read through that data, I read through your comments, and it always helps. All right, everybody, thanks for giving me your time today. I will see you in a future webcast. I'll also look for you on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy investing. Bye-bye.